Hello and welcome to Market Brief After Hours. Today we are looking at a market session that seemed to take a collective, deep sigh of relief. The overall vibe on the trading floor was decidedly positive, a welcome pivot from the inflation-driven anxiety that has dominated our airwaves lately.
Yes, relief is definitely the word. We saw a powerful rebound across major Western indices as two of the biggest recent pressure points, surging crude oil prices and skyrocketing Treasury yields, finally started to ease up.
Let's jump straight into the key takeaways. What were the critical events that defined today's session?
There were four major drivers. First, geopolitical tensions in the Middle East showed signs of easing after President Donald Trump speculated negotiations with Iran are in their final stages. Second, this caused crude oil prices to plunge over 5%. Third, bond yields came off their multi-decade highs, giving equities breathing room. And finally, after the bell, Nvidia delivered a blowout earnings report announcing an $80 billion buyback and dividend boost.
That is a lot of market-moving news. Let's look at U.S. markets. The major indices posted strong gains. Walk us through those numbers, rounding them to the nearest whole number.
It was an impressive showing. The Dow Jones Industrial Average jumped 645 points, or 1.31%, to close at 50,009. The S&P 500 rose 1.08% to finish at 7,433, while the Nasdaq Composite added 1.54%, ending at 26,270.
This rally was heavily supported by the Treasury pullback. Tell us about that yield movement.
Absolutely. The bond market has spooked investors recently. The 30-year yield had hit its highest level since 2007 on inflation fears. Today, however, the 10-year yield tumbled over 9 basis points to 4.576%, and the 30-year yield shed over 6 basis points to settle at 5.116%. The policy-sensitive 2-year yield also slipped by over 7 basis points to 4.047%.
We also saw interesting details from the latest Federal Reserve meeting minutes. What did they reveal?
The minutes from late April showed a highly divided central bank. The Fed kept rates unchanged at 3.5% to 3.75%, but the decision drew an 8-4 split, the biggest dissension in over 30 years. A majority of officials expected rate hikes down the line if Middle East conflicts continued to exacerbate inflation.
Meanwhile, the mortgage market is still feeling the heat, right?
Yes, the average U.S. 30-year fixed mortgage rate jumped 10 basis points to 6.56% for the week ending May 15th, its highest in 7 weeks. Consequently, mortgage applications declined 2.3%, with home purchase applications slumping 4.1%.
Let's look at the energy markets and the massive crude inventory draw.
WTI futures fell 5.66% to close at $98.26 per barrel, while Brent crude dropped 5.63% to settle at $105.02. Interestingly, the U.S. drew down a record 17.8 million barrels of crude from stocks. Commercial inventories drew by 7.86 million barrels to 445 million, while the strategic stockpile eased by a record 9.9 million barrels. Additionally, the UAE has accelerated a second pipeline to bypass the Strait of Hormuz, doubling ADNOC's export capacity, aiming for a 2027 launch.
And finally, Nvidia's post-market numbers were staggering.
They were. First quarter revenue grew 85% year-over-year to $81.6 billion, and they projected next quarter sales at $91 billion, well above expectations. They also announced an additional $80 billion buyback and raised their dividend. The company is boosting its quarterly cash dividend to 25 cents per share, up from just 1 cent previously.
Now let's turn to Europe. European stocks seem to catch a strong bid today.
Indeed, the Pan-European Stock 600 finished 1.5% higher. In regional markets, the UK's FTSE 100 rose 0.96% to close at 10,429. France's CAC 40 went up 2.09% to 8,149, while Italy's FTSE MIB rose 1.71% to close at 49,182. Germany's DAX 40 gained 1.4% to close at 24,737, its highest since May 6th, and Switzerland's SMI ended 0.26% up.
What drove that sentiment, and what is the inflation picture looking like over there?
UK inflation cooled more than expected to 2.8% in April, down from 3.3% in March. However, the euro area's annual inflation was confirmed at 3.0% in April, driven by a 10.8% surge in energy prices. Looking at major economies, inflation accelerated in Germany to 2.9%, France to 2.5%, Italy to 2.8%, and Spain to 3.5%, while moderating in the Netherlands to 2.5%.
Let's move to the Asia-Pacific region, which didn't share the same optimism today. What dragged them down?
Asia-Pacific markets fell as they had to digest high Treasury yields and geopolitical tensions earlier in the day, especially after President Trump's warning that he was close to striking Iran before postponing it. In Japan, the Nikkei 225 fell 1.23% to $59,804, while the Topix declined 1.53% to 3,791.65 cents. Okuma Corporation dropped 9.99%, Fujikura lost 8.52%, and Sharp fell 6.12%.
There was also some notable activity in Japanese government bonds.
Yes, the 30-year JGB yield fell over 9 basis points to 4.068%, but the 5-year yield climbed to a record 2.041%. Masahiko Liu of State Street noted that high Japanese yields are feeding into a global duration reset, though it should tighten conditions gradually rather than cause systemic stress, since Japan's market is domestically financed.
How did the Chinese and other regional indices perform?
China's Shanghai Composite slipped 0.18% to 4,162.18, while the Shenzhen component was flat. The PBOC kept benchmark lending rates unchanged, with the 1-year LPR at 3% and the 5-year LPR at 3.5%. Hong Kong's Hang Seng declined 0.57% to 25,651, with BYD dropping 3.94%. South Korea's Kospi 100 slipped 0.5% to 8,750.02, hit by AI derating and Samsung labor strike pressures. Australia's ASX 200 dropped 1.26% to 8,496, and New Zealand's S&P NZX 50 fell 1.64% to 12,761.
A tough day for Asia-Pacific. We are going to take a quick break. Coming up next, we'll dive into the Forex markets and key technical levels, plus look at some of the day's major individual market movers. We'll be right back. Welcome back to Market Brief After Hours. Let's head straight into the Forex and commodity markets. I understand Bank of America is predicting a summer rally for the US dollar based on a classic technical signal.
That's right. Bank of America Securities highlights a golden cross pattern in the US dollar index, which triggered on April 7th when it closed at 99.86. Historically, these signals carry a bullish trend bias. Out of 39 occurrences since 1971, the dollar index has been higher 20 to 70 trading days later, 66 to 79% of the time, pointing to a potential summer rally.
Let's examine how this is playing out across major currency pairs, starting with Euro-USD.
Euro-USD closed at 1.1629, up 0.20%, trading between a high of 1.1645 and a low of 1.1583. The pair is trading below its 50-day simple moving average at 1.1649, its 200-day SMA at 1.1682, and its 100-day SMA at 1.1702. Support is solid at 1.1583, but a daily close above 1.1649 would ease immediate bearish bias.
What about the British pound against the greenback?
GBP USD recovered to reclaim short-term moving averages, closing up 0.34% at 1.3440. It hit a high of 1.3464 and a low of 1.3375. Price closed just above its 50-day SMA at 1.3430 and its 200-day SMA at 1.3425, though it remains below its 100-day SMA at 1.3479. Holding above 1.3430 keeps the tone constructive.
And the Australian dollar?
Australian dollars surged 0.74% to close at 0.7159, trading between a high of 0.7174 and a low of 0.7087. The pair defended its support near the 50-day SMA at 0.7091. Since it stays above the 50-day, the 100-day SMA at 0.7015, and the 200-day SMA at 0.6787, the broader uptrend is completely intact.
Let's look at USD JPY next.
USD JPY consolidated, down 0.13% to close at 158.87, trading between 159.17 and 158.59. It continues to hold above its 50-day SMA at 158.77 and is well above its 100-day SMA at 157.49 and 200-day SMA at 154.63, keeping the overarching bullish structure intact. Support rests at 158.59.
Turning to commodities, gold and silver both staged impressive recoveries.
Gold closed up 1.40% at $4,546, off a low of $4,454. It remains below its 50-day SMA at $4,691 and 100-day SMA at $4,787, but is trading above the long-term 200-day SMA at $4,341. Meanwhile, silver surged 3.12% to close at $75.94, testing its 50-day SMA at $76.32 from below. It is under the 100-day SMA at $81.09, but well above the 200-day SMA at $64.84. Holding above support at $73.13 keeps the bias constructive.
Let's look at today's major corporate winners and losers. Who stood out?
In the winner's circle, Toll Brothers closed up over 9% after reporting second-quarter revenue of $2.53 billion, beating the $2.43 billion expected. AI infrastructure stocks and chip makers rallied high, with ARM holdings surging over 15%, while AMD and Intel both gained more than 7%. Etsy also jumped over 5% following an upgrade to buy from a REIT with a $76 target.
And who fell out of favor today?
Intuit shares fell over 3% after announcing layoffs of 17% of its workforce, about 3,000 employees. Hasbro dropped nearly 9% after reaffirming its full-year EBITDA outlook and announcing second-quarter cybersecurity breach costs.
To wrap things up, what is the outlook for the coming sessions?
The market's relief rally is a positive sign, but structural challenges like high global public debt, stubborn core inflation, and a divided Fed mean that volatility is likely to remain high. Investors should stay nimble.
Thanks for joining us. If you find this useful, please follow Market Brief after hours.